If you were like me, you would have been wondering, what is an IUL? Everyone keeps talking about it in the financial space. It must be something important. Maybe, maybe not. These and other questions, hopefully in this video, will answer for you here today. An IUL stands for Index Universal Life. So the IUL was first introduced in the 1990s by an insurance company by the name of Transamerica. Now, the IUL didn't stand alone by itself because an IUL is literally a brainchild of a former insurance product by the name of Universal Life. Now, Universal Life, or otherwise known as a UL, was first started in the 1960s, but then later popularized in the 1970s and late 1980s. The IUL, Index Universal Life, is a life insurance product that also comes with cash value, such as a whole life product. However, the cash value doesn't come from the insurance company like a whole life product comes from. The cash value is built through the index, such as the S&P 500, uh, BNB Paribas, you name it, whatever index that is traded on the stock market. If the insurance company is using that index, that's how the cash value in your policy grows. The best way for me to explain what an IUL is for you to imagine two buckets. Now, in these two buckets, what I want you to imagine is one bucket has life insurance. Now, that's where your premium is going into funding. It's going into funding the death benefit. Now, just as in your regular whole life insurance, the other bucket also comes with cash value. And that cash value is the interest that the insurance company, through their investments, are crediting to you as a partner who is investing with them. Okay? Now, unlike a whole life insurance policy, the cash value in which the insurance company is crediting you is not based on their own bonds or their specific own investments. The IUL is based off what a specific index on the S&P or BNB Paribas is actually giving back to the money that the insurance company is investing on your behalf. Now, the real sticker or the real thing that I want you to remember with this is the IUL is meant to keep your money safe from market volatility. So you will never lose money on a market downturn, but you will always participate in market increases every single time. So your principal stays safe while your cash value grows but never decreases. Now, unlike a whole life policy, the cash value isn't growing on a fixed 4% increase every single year. The difference between the IUL and the whole life is, as I was just saying, the whole life is based off the insurance company's own investments, so with their bonds and different investment strategies that they have. The IUL is based off a specific stock performance. IUL policies, they have an illustration of about 5.5, 5.6. Now that's a good thing. However, when you look at the market, you see that the market usually, S&P 500 for the last 10, 15 years, has usually given a market rate of return for about 8%. Now, the reason why the insurance companies don't show you a market return of 8% on your illustration is because they're an insurance company and they want to make sure that you're coming in there with a relatively honest assessment of what can happen. So it's not going to be zero that you're going to get, but they're not going to show you 8, which the market typically gives. They're going to show you a decent solid return on your investment every single year. So you don't get your hopes too high, but you'll also realize that you're still going to be getting more than that 5.6 rate of return on your investment every single year. So just to summarize, these two buckets include life insurance, plus with the IUL, you have cash value that's being credited to you by the insurance company, by their investments that they're getting from their returns in the stock market. Okay? Your principal will always remain safe. You will supposedly never lose any of your principal in your cash value. The death benefit, if you have a level policy, will always remain level. Now, if you have an increase in policy, that's where the differences may come up. Okay, but for the most part, most people that get an IUL, they usually get the policy because they want the insurance, but they also want a little bit of cash value as well. So most people sometimes get level. If you have an increase in policy, we can talk about that a little bit later. But for right now, for the scope of this video, we'll just talk about level. All right. So for most people, that's what they'll get on their policies. the death benefit will remain the same and the cash value will increase, but you will not participate in any market decrease. So your principal or your cash value stays safe. Comparatively to if your money was just stuck in the market and stuck in some other type of policy with someone else, your money is typically at risk for market downturns as well. Okay? So with this, you're getting the death benefit plus again to participate in the market. Now, as I spoke about a little bit earlier with the increasing death benefit policies, this is where the premium sometimes gets a little bit different. It can go up, it can go down, because what you'll be paying on is the amount of death benefit as well as market participation that your money is giving back to you. The interest that the money is giving back to you based on your market participation as well as the death benefit that your policy has. So if you have increase in policy, sometimes, not all the time, depends on the insurance company. Sometimes your premium might increase and then it will drop off when the policy reaches its level term, and then your policy will remain level for the full life of the policy. Now, for most people, the IUL is going to remain level until they pass away, all right, or until they fully reach their break-even point, which means that the amount of cash value that you have is pretty much equal to the amount of death benefit that you have. So you pretty much become something that's called self-insured. All right. Now, the scope of this video was to keep it very simple. Obviously, there's way more details that can be talked about with an IUL and how it can be beneficial for you. But before I leave, we'll delve into a little bit of it. Now, who is an IUL for? Is it just for you because you have a pulse? I don't know. Maybe. I believe everyone should have a decent amount of life insurance for themselves so they can pass on a proper, decent legacy to them and their family. Okay. Now, some people have called the IUL, Index Universal Life, the Swiss Army knife of insurance products because the IUL has been touted as a way to college fund, also as a way to save for retirement comparatively to the regular average 401k and comparatively to the average Roth IRA. It's been said to give you a greater amount of return so that you can have more money when you decide that you want to retire for yourself. Now, let's say that you have a business idea where you want to eventually start investing in different products for yourself. A great way that you can, it might not be an IUL, but you can use a whole life investment policy for this as well as the IUL. A great way to start building a business empire for yourself without going into traditional debt with a bank or any credit card companies is to start an IUL or a whole life insurance policy and have it aggressively grow to push the growth of the cash value so that you can eventually take out um, quote unquote a 0% loan for yourself where you technically should pay it back to the insurance company, but technically if you don't pay it back, just take it out of your death benefit and you pretty much walk away with a loan. Now, I'm not saying to do that. You should always pay back your debts because the money that if you do borrow from the insurance company is going to come out your death benefit. You want to keep your death benefit safe because that's what your beneficiaries are going to inherit when you do pass away. But that is a way that a lot of people have been using whole life and IUL over the last couple of years to start funding businesses, start funding business ventures, start doing this, that, and the third. It's a great way to actually get an investment for yourself without no market risk, no market volatility, and don't have to worry about getting interest from these credit cards or bank companies for yourself. You pretty much are becoming your own bank when you do it properly. So this was just a rudimentary explanation of what an IUL is. Of course, there's more details, more nuances of a policy. You can choose this stock index, you can choose this rider, you can choose this level benefit, you can choose this amount of premium that you want to pay. So a few different things that if you want to make sure this plan works properly for you, that you'd want to sit down with an advisor and actually get broken down to you and for you to see how it might be of benefit for you and for your family. Now, if you're like that and you want to receive some more information, feel free to reach out to us, comment, shoot me a personal message, direct message, depending on which platform you see this on, and we'll reach out to you and try to get you as much help as we can. Thank you and take care.